Hi, I'm Josh Young with Bison Interests, and today we're going to discuss Unbridling Journey's Full Potential, Duvernay Debacle. Please make sure to read this disclaimer. None of this is an offer, solicitation, or recommendation. Just a little on Bison and our background. We invest in publicly traded oil and gas companies. We've done quite well since we launched about a decade ago, and in that time we're up close to 70% versus the S&P 600 Energy Index, which is composed of small cap publicly traded oil and gas companies, which is down 59%. We also own about 5% of Journey's outstanding shares, and I was formerly chairman of a company called RMP Energy, which was renamed Ironbridge. And from the time I was chairman till when we sold the company, we materially outperformed our peers in that space. And we were able to sell the company for a profit despite a substantial sell-off of companies focused on those particular kinds of assets in Alberta in that 2018 timeframe. Today we're going to discuss Journey's Duvernay assets, the potential value of those assets, some of the challenges to those assets, and a potential solution to a funding gap that Journey may be experiencing on those assets. So first, for some background, Journey got into the Duvernay shale play a number of years ago, leasing what was at the time a quite large land position, and using their own numbers for calculating net present value, as well as looking at recent land sales. By inaction and through a failed prior partnership, Journey lost a significant portion of its land position, which represents potential value of over $100 million, which is close to Journey's current market capitalization. When we look at Journey's current land position in the Duvernay, this land position, per their analysis, would support over 60 net well locations and generates net present values per well of over $10 million. So a $12.5 million well would generate close to what is this? $23 million of present value, and would get to pay out in about 1.3 years. And recent wells have significantly outperformed versus expectations and versus prior generations of wells. It is pretty exciting to see how these wells are performing both on Journey's land as well as on offsetting land in both directions by operators including Paramount Resources, Spartan Delta Corporation, and Baytex Energy. And the uplift in well productivity has been really remarkable and also promising for potential future improvements in well productivity and therefore well economics. Next up, we're going to discuss the challenge that Journey is facing with insufficient liquidity potential to fund its Duvernay drilling this year and in the future. So Journey may not be able to afford to participate in all of the Duvernay wells that may be proposed under its joint venture with Spartan Delta. When we look at Journey's 2025 expected Duvernay capital expenditures based on their agreement with Spartan to pay their proportionate share, they could be on the hook for roughly $30 million of capital versus only having about $23 million in their budget to participate. This lower spending seems likely to be due to liquidity concerns, where when we look at Journey's current budget and their run rate cash flow at recent commodity prices and recent exchange rates, which are relevant because the oil price that they show is in US dollars and then converted over, and even using relatively generous commodity price assumptions, there seems to be roughly a gap of 13 million or so versus the potential draw for Journey's participation in Duvernay wells in their joint venture with Spartan Delta this year. And next year, that problem could be quite a bit worse, again, dependent on commodity prices, as well as Journey generating the cash flow they're projecting and meeting the financial obligations that they have elsewhere in their business that they are projecting. Unfortunately, Journey's management's track record of delivering on their guidance is extremely poor, which is a reason for us to highlight this risk at this time. We are concerned that, as Journey has for 9 out of its 10 years as a publicly traded company, that Journey may continue to disappoint and overpromise and underdeliver. And given this track record, we see a risk of material further downside to Journey's cash flow, which could lead to an even bigger gap in its ability to fund its participation in these highly economic, very fast payout, very impressive and, again, improving economic wells. Unfortunately, our concerns were surfaced and, I guess, validated through recent public communication by the CEO of the company, who shared via social media that skipping 2 or 3 Duvernay wells would not have a material impact to Journey's intrinsic value and to its ability to execute on its plan. When we look at this, though, we look at the numbers for Journey and for these Duvernay wells, this is much less of a casual or surface concern, again, in the context of the repeat misses on production guidance and cash flow that Journey has experienced over the course of its public, of it being public and with this management team running the company. And when we look at what the benefit is to Journey of missing, let's say, 4 gross wells, which we think is maybe a more realistic expectation considering Journey's guidance, its history of missing guidance, and then the potential call on capital for Duvernay wells in 2025, we see an initial savings, which is really just Journey not spending this money, but then missing out on enormous cash flow over the following few years. And this is using their own type curve and using the pricing assumptions that we include below, which are very similar to the current price for oil and natural gas and the current commodity price, and even using a little bit of a cost savings on the wells based on recent guidance from Journey and Spartan that the wells are coming in a little under guidance. So now we're going to talk about one potential solution to this problem, which we think ties into a general concern around Journey and how they have financed their business so far. So we'll get into it here. So one possible solution, especially given the high esteem that the Spartan team is held in and their track record of numerous successes across different shale plays in Canada and financial success for their investors, is to bring in an outside financing party. And this is frankly par for the course at this point in the oil and gas industry, a little less so in Canada than in the US, but when I attend oil and gas investment conferences, whether they're public or private oriented, whether they're smaller company oriented or larger company oriented, it's hard not to run into people who are looking to deploy capital in this particular structure. And frankly, given the competitiveness of this structure, as well as the abundance of private debt capital that's looking for yield and looking for a home, we think that there's actually likely a deal that Journey could do that would be substantially more favorable than these terms. We just think this would be a deal that, based on recent deals that were announced like this, that would be very, very easy to get done. And so we just used a higher cost deal to show it. Basically, the idea is that the outside party comes in and funds the wells for Journey, gets a 20% annualized return, meets a 1.2 times hurdle, and then after that delivers full ownership back of the asset to Journey. Most of these deals are much more complicated, but using this sort of simplistic deal, along with terms that we believe might actually be a little rich versus the current market, is conservative and we think is indicative of the missed opportunity to be able to finance some of this high return activity off balance sheet. So when we modeled this out, and we looked at the potential cash flow impact to Journey of using a drill co to essentially fund its participation with Spartan over the next few years, we see that by doing this, Journey is able to not draw a material amount of capital, which is important because Journey's cost of capital has been escalating, and each one of those major draws has been increasingly dilutive to the detriment of Journey public shareholders. And so there is this really big gap in cash draw where by using a drill co under a scenario where Spartan tries to accelerate, which would make sense given the extreme improvement in well productivity and rate of return, along with potential additional improvements in productivity and rate of return, in a situation where Spartan escalates and accelerates its activity in a time frame where it's allowed to from a contractual perspective in its joint venture, there could be a cash draw on Journey well in excess of $50 million, where there's not really a line of sight in Journey's current capital structure to fund that without very substantial dilution. And in this sort of model, you could end up in a situation where by 2029, Journey's generated 50 million or so of free cash flow without having put a dollar of their own money or a dollar more of their own money into these wells, where there could be this maximum cash draw of well over 50, closer to $100 million if Journey tries to fund this on their own, peaking by late 2027. Alternatively, many operators choose to do this in the US, and some operators have started to do this in Canada. There's always the opportunity where when Journey is presented with essentially a bill for a well, to turn around and resell that right to participate for consideration. The market for these sorts of opportunities is very rich here in the US, very active and competitive, and we've seen a number of private equity backed and family office backed groups start to get active in Canada. And one even was active on a podcast talking about how they had bought a number of these. I think their deal was slightly different where they structured it with the operator, but it was very similar to this sort of opportunity. Again, it's not that we have a strong preference for any one of these, it's that we think it makes sense for a company like Journey that has suffered from poor financial management over its life as a public company to be evaluating these sorts of off-balance sheet funding opportunities to capture value that the company's CEO has said he is okay with, quote unquote, skipping. Again, just looking at this history of financial management, we are concerned by the numerous occasions of warrant issuance and convertible debt issuance, and by the rapidly escalating cost of debt to Journey. And we'd point out that the higher cost of debt for Journey makes taking off balance sheet financing in a drillco type structure much more attractive than it normally would be, because in many cases that sort of financing is many times more expensive than a company's on balance sheet cost of capital. And there are significant advantages to doing this sort of off balance sheet, no recourse other than to the assets that are being funded type of financing, where if there's a commodity price crash or there's various other concerns or problems, this reduces the risk to the overall corporation. And whether or not Journey does this sort of financing on this particular asset, we'd observe that over the history of Journey, there's been enormous dilution and value destruction through its financial management, and that at least some of its projects, whether it's the power generation or the Duvernay or various other projects, may have substantially benefited from slightly more innovative, but also, frankly, lower risk financing approaches. So with that, I'm going to wrap this up. Appreciate your time and your interest today. Please don't hesitate to reach out if you have any questions or concerns. And again, none of this is an offer, solicitation, or recommendation. Hope you have a good day and a happy new year. Take care.